This episode is brought to you by Paraswap, the leading aggregator to find best prices across various DEXs. You'll hear more about them later in the show. All right, everyone. Another special episode of Empire. We are missed by our dear friend Santiago today. Santi's flight got canceled, so he was not able to make it back to his recording studio. So I will have to bear the brunt of this one, hold down the fort. And thankfully, I'm joined by not one, but two DeFi wizards today. Starting out, we got Tarun Chitra from Gauntlet, founder of Gauntlet, also a partner at Robot Ventures. Previously, he was at, I think, Vatic and DE Shaw on the quant side of things. And then also Tom Schmidt, who was on the product team at 0x before joining Dragonfly, where he works with some of our friends over there on the investing team. So Tom, Tarun, welcome to Empire, guys.
Hey, what's up?
Hey, thanks for having us.
Of course. Cool. So I think let's start. I want to start with like frameworks, and it's been a little bit of a crazy couple of weeks in crypto. Tom, you come from this like crypto investing background. You're usually like 18 to 24 months ahead of the curve, trying to figure out where the space is going. Tarun, you kind of come more from the quant side of things, battle testing, like tokenomics, schemas and things like that. I kind of want to start with just frameworks for how you're each viewing the space today, right? So we're recording this on January 31st, 2022. What is, Tarun, I think let's start with you. What is your crypto framework for just like where we're at and where we're going in 2022, considering everything that's happened so far this year already?
Yeah, I mean, I think hopefully we had a healthy correction that sort of, I think like it's very easy in this space to have things be overheated. And then you kind of end up with like very reflexive products being built that don't actually like provide a lot of like user value. And in the bear markets, and I mean, historically, bear market means many different things in crypto, but let's just say in some conception of a bear market, most of the biggest innovations that like persisted were made, right? So like the bear market last time brought us a lot of the big NFT games like Axie. It brought us Uniswap, brought us Compound, brought us new chains. And I think like in some ways, each correction is actually really healthy for new technology. At this point, it'll probably be things from my investment hat side, I definitely would say most of what I've really been looking at is like sort of infrastructure for NFTs and zero knowledge proof related things. So I think like that to me is most top of mind. I feel like, the most amazing thing is all the DeFi coins are down, but like all the DeFi protocols are still like not that far from record TVLs. So it should kind of say it kind of there might be some sort of like, activist investing type of stuff I foresee in the next year outside of, the failed SPAC of Daniele.
Tom, what about you? What do you what's kind of your framework for how you're positioning and just seeing the entire industry right now?
Yeah, I think we also felt things were extremely overheated, over the past few months. And I always pains me to say this because this is what every investor in a bubble says, but it really does feel very different this time. You do look at the usage of these protocols, as Tarun was saying. You look at sort of the utility that they're adding as opposed to just being vaporware. You look at the types of investors that are coming into the space. Like it just feels materially different. I mean, we were talking about the fact that like NFT profile pictures are now like a core feature on Twitter. Absolutely insane, kind of unmanageable. 2 years ago, the hype is real to an extent. That said, there's always a few layers of additional hype on top of whatever reality is in crypto, and so you have to kind of have to be prepared for that. But I think increasingly it feels like we're sort of breaking out of a lot of the core, the basics and the core primitives, and building into sort of new layers of the stack that in my mind are maybe a little bit more exciting. I think one area that I'm actually really excited about right now is sort of the whole DAO tooling plus like crowdfunding space. I think sometimes you sort of see this moment in crypto where it's like one team figures out maybe very roughly a very core concept. This was sort of like Compound with liquidity mining. Someone sort of figures one thing out and maybe they don't appreciate it at the time, but it sort of becomes like a new core mechanism. And I feel like Constitution DAO sort of tapped into some spark when people realized that you could use this technology to do global decentralized capital formation. And I think as soon as people figure out a way to repeat that process, we're going to see just an incredible explosion again, the same way we kind of have for those other two categories. So that's an area I'm super bullish on, and I just see a lot of great teams entering the space, and just an incredible amount of talent coming into the space as well. It's very, very impressive to see.
Yeah. All right. One of the reasons I want to bring both you guys together is to get your guys' take on kind of the current tokenomics stuff. And Tom, I want to bring you on because when all this kind of VE curve stuff was going on, you're like, whoa, stop. Like, let me call out some of the bullshit that I think I see going on. And Tarun, obviously, like you live in some of this stuff day to day. I think everyone right now is thinking like, everyone was thinking like, okay, VE is like the future. And then like, okay, some of these Ponzonomics things are like the smartest thing ever created. And now maybe obviously with this kind of like Frog Nation debacle that we saw last week, maybe it's not. And like Olympus DAO and Wonderland, all that kind of stuff getting hit pretty hard, right? So it feels like this could be kind of a pivotal moment where the pendulum swings back. And what I mean by this is in DeFi, the kind of beginning of the cycle, the only DeFi projects that exist are these VC-backed, high-quality teams, right? Compound, Aave, Uni, Maker, right? And they were like these VC-backed projects that kind of came out of like 2018, 2019. And the VCs funded them and got them through to launch. And they became what we know as the tier one DeFi projects. And then Yearn and Sushi came along and kind of pioneered this like fair launch, community-driven project playbook. And then Olympus DAO obviously kind of expanded on that. But then what you got is lower quality teams came in, VCs kind of came like pouring in even more. You started to see more like high, fully diluted value, like low float, retail gets dumped on by the time of the unlock. Narrative around VC-backed projects starts changing. But this 0x Sifu episode, to me, feels like it could be a huge shock to the system in terms of trust, right? Where now you've got this, like, the community felt like trust was kind of breached by these exploitative VCs last year. But hey, maybe actually the VCs are really helpful for doing due diligence. And now some of these, like, anonymous folks running these communities, maybe it doesn't seem as good. You guys agree with that? Do you guys think this could be kind of this pivotal moment, or am I overreacting here?
I guess I think one thing that's important to remember is that the label VC has grown in a manner that I think is unsustainable. Like, if I just start calling anyone who has any capital to deploy a VC, then like that kind of describes the scenario. I think what really happened a lot in 2021 was a lot of trading firms realized that by rebranding as VCs, they were able to basically capture a lot more upside and also like negotiate shorter lockups, because there were tons of new founders who were just like, I want to launch a token. And there are tons of trading firms who are like, I know how to front run the founders and the team. And so like we had this very weird like adverse selection problem of like the shittiest founders, no offense, really were just like taking horrible terms from a lot of trading firms. And the trading firms would do something where they give them like $100 million valuation, have a 3-month lockup, and then, obviously would just dump right in front of everyone. And I think that got extended to the Anon farms in a lot of ways. Like that kind of behavior and kind of like adverse selection cost, and like, hey, we're just going to copy some other protocol, change a couple lines, bolt in a new token, like something that was like a hackathon project. And like we're going to launch it and raise, $50 million that gets dumped as soon as possible. That kind of deleterious adverse selection, I wouldn't consider that traditionally something venture capital normally does. There's adverse selection in every type of finance, right? Like no matter what. But it's not this type of adverse selection. I think the problem is that, most people started just calling everyone VCs who had more than a certain amount of money. And I don't think that's maybe that realization is finally coming true. But I maybe this is a pivotal moment, but I think the bigger pivotal moment is just like the asset prices crashed. I think people realize that, you have to discriminate a little bit on like what different types of investors are, what their duration expectations are, stuff like that.
Everybody's an angel when the prices are going up, right?
Yeah. That's how you get your community. I think maybe just to double click on this, I think Tarun touched a very good point, and maybe for listeners, like venture capital is kind of a niche asset class. It's a very specific kind of fund. It's a closed-ended fund. You're holding investments for a 7-year plus time horizon, generally 10. And so when you're doing an investment, it's like getting married, right? It's like, we have a very long lockup, we have a very long vesting schedule. We're in this, till death do us part. And it's very, very different than I think, how people generally, as an individual, that's not really how you generally do investments, especially in crypto. A lot of people are into trading and flipping and mining and and so, VC is not just that, but with more capital. It's like a very different style of investment than I think a lot of people are used to. I think maybe the point I feel is like I'm maybe kind of like a tokenomics bear. I think tokenomics are kind of like steroids or stimulants. It's like if you already have a good baseline, then they can really sort of propel your growth, and they can be used. You can use a token well to sort of your advantage to build a moat or to promote traction. But if your project's dead, sticking someone full of a bunch of stimulants isn't going to bring them back to life. You need something good to sort of build on top of. And I think that's been my point around a lot of these projects. I think, you bring up something like sushi, for example, and it's like sushi is not dying because the sushi tokenomics were not correct. Sushi is dying because UniV3 is such a better product than sushi. And so, I think my sort of investment philosophy, I'm not super, principled or thesis driven. I'm not like, this is kind of the way this should work, or we can rework the tokenomics in this way. It's like, I just want to invest in great teams building great products that I want to use, that are solving a problem that I have or that someone I know has. And so if you're not building a product that's solving a real problem, which is hard, it's a lot harder to do good product development than it is to introduce some wacky token staking thing. Then it's hard and scary, but that's kind of the way you build a great sustaining protocol and project. And I think that's sort of emblematic of the most successful project in the space.
I would also add one thing, which is yes, one interesting thing is that sushi, however, is actually still doing reasonably well, like from a pure DEX metrics standpoint. And part of the reason for that is that it's actually competing with a different market than UniV3, right? UniV3 sucks for new projects, low market cap, and small, kind of new token issuance that you need to incentivize somehow. And it's actually much, much easier to do in UniV2/Sushi. And I think the more crazy thing, and this is why I mentioned activist investing in the beginning, is that there are these protocols that are sort of the coolest thing about this space, right? Is that these protocols, even when the development team might not be there and abandoned, is still running. And if it fits a niche, they might actually have quite a bit of use case. I don't think it's just sushi, though. I wouldn't necessarily just say hey, they're the only ones. I think there's going to be a lot of this type of stuff happening.
Tarun, I want to just go deeper into the activist investing stuff. So what do you mean by the activist stuff?
Yeah, so there's two types of things, right? So in traditional markets, right, if you have an activist investor, you have this investor who slowly buys a bigger and bigger stake in the company. Usually they have some, kind of the same way that crypto governance has these kind of quorum thresholds that are quite low. A lot of equities only require you own 5% of the asset to force a board meeting or force a vote on something. And so, activist investors will buy up whatever that percentage of stock is, try to force a vote to force out the CEO or to force the buyback or something that gets voted on. And then they sort of if they're successful at convincing people, then they basically now kind of have been able to change the company in some way. Activist investing in DeFi is going to be something similar of aggregating a big position, sort of writing the code for a governance proposal and for changes that you want to make, and then convincing whoever's still a token holder to vote on it. And in general, I think a lot of these tokenomics games that fail will likely lead to kind of more activist investing. And this happens in normal finance too, right? It's if I do way too many buybacks and the company's top line isn't growing, eventually there'll be someone who's the Bill Ackmans of the world who'll be I think we need to go in and stop buybacks, or I think we need to go in and do X, Y, or Z. And there's no reason you can't do it here other than everyone who wants to be, what I've observed in crypto is that everyone who's from traditional finance who wants to do activist investing can't write any code, so there's no way they're going to actually be able to execute these things themselves. And everyone who's like more of a like technical kind of investor who has like a development team or whatever, they don't want to or don't know how to don't want to like do the lobbying effort and stuff to do activist investing. But this is the year I suspect like the non-technical kind of very traditional people like Arca and like then the more technical funds who, you know, have big positions who might be kind of trying to do things, you know, maybe like Jump, somewhere meet in the middle and we get like some type of like activist thing.
Yeah. I think I can see that in some scenarios, like Arca's been pushing for like the Gnosis treasury stuff, trying to get them to like, you know, use their treasury better or distribute. I think we will see more activist investing. I agree with Tarun, but I think part of the problem is there's such a low cost of capital, low startup threshold in crypto that like if you really don't like the way a product is going, you're almost more compensated or incentivized to start your own thing as opposed to trying to improve the existing product. And I think, you know, if you're smart and you're in crypto and you can write code, like 9 times out of 10, you're better off starting a new project and, you know, owning some of that token supply as opposed to like trying to buy in and improve, you know, the value of sushi. You know, it's like it's just sort of a pure math thing because it's not like starting a brick and mortar business where there are, you know, years and tens of millions of dollars in upstart capital required. It's literally just a couple days and a code fork and a nice UI, and now you have your own competitor to whatever the thing is.
When in activist investing in traditional equities, like when I think about activist investing, you've got someone like Bill Ackman who comes in and actually tries to make the product better. Oh, I guess some folks do it differently, right? Some people just try to suck as much value out of the company as possible. But in crypto, will the activist investors try to make the network more valuable by maybe either changing tokenomics or by making a better product? Or will they purely try to focus on the financial holders and just increase the price of the token?
I think it's probably some combination of both. I mean, in theory, right, the better the network does, the better the token does. And I think on a long enough time horizon, that will be true. I think the stuff that we've seen so far tends to be more about token price. And I think that a lot of the network improvement stuff is not really done by large shareholders. Like I think about like Getty, like Grapefruit working on Compound, and like, you know, he's not, you know, the seed investor of Compound and owning 10% of the token supply. He's just a guy who obviously has a bunch of, you know, comp delegation, but like it feels very different. It feels more, I guess, you know, striving to make fundamental improvements to the protocol versus trying to, you know, do some financial engineering on the price of the token.
When I think about kind of like if I'm making decisions at a protocol, like in a project, I'm kind of weighting like my emphasis and my focus on the product, my focus on the token, and my focus on the community. So I think there's all this hype and like a lot of hype around like the token side of things right now, right? And then there's also a decent bit of like focus on the community. But when I think about projects that have won, it's the folks who have served the users by focusing on the product. And again, I think that would tie back to what I was originally saying. I think there might be like pendulum swinging on community where maybe having this like cult-like community is not actually a powerful moat, but like a red flag almost, and like a point of risk.
I think of it sort of like a Maslow's hierarchy. I mean, I do agree, like you need a good protocol, you need a good product at the end of the day. If you don't have that, you know, I think part of the thesis initially with some of these sort of, you know, meme projects or cult projects or just super highly, you know, reflexive projects was that, well, we build the community first and we build up a token price, we build up a treasury, and we use that to then, you know, buy the talent and improve the product. And over time, we sort of like grow into the valuation in a sense. I think Chainlink was arguably one of the first where, you know, it's a fine product, it's a fine Oracle, token is kind of whack, whatever. But it sort of created this meme and this community around it. And now they have an incredible team. They have like Ari Jules on their team, and they have like an incredible. We just hired a researcher from Chainlink who's you know, incredibly smart. And so, you know, in a sense, they're maybe like one of the few teams that's actually executed on it. But everyone else so far has sort of failed on the second step, which is the hardest part, which is the fundamental part, which is building a great product. And it's not necessarily something you can just throw money at. I think the community stuff, I you know, tend to agree, but I think it maybe not so much as building a cult, but being loud about your product. Most products kind of die in silence. And if you don't start building up that feedback loop and getting people actually using it, then you never even have a shot at becoming successful, at becoming that tier one protocol. So, it's not, I think, desirable to have an extreme cult, maybe, on a Frog Nation level, but you do still need to be loud about what you're building in the early days and start to build that initial community and get people using it, and not just sort of hope people are going to show up and figure out how to use whatever it is that you're building.
Tarun, is there something that, like, when you work with founders, is there something that changes based on where we're at in the cycle? Where you're like, oh, it's a bull market, like, let's over optimize for X, or it's like, oh, now we're in a bear market or like a down market. Maybe we should like over optimize for this, or there's like option C where you're like, I don't give a damn what the tokens and like what the market is telling me right now. Like, here's how you should build something.
I would say I don't have quite something where it's like so market dependent, as much as it's more dependent on like the person and their idea. And so like, I think if I look at my investments over, our investments over the last 6 months, I would say that, a lot of them were either existing teams that like built their product before things got crazy and like were already kind of working in the space for a while. Or they were kind of on the edge, right? They were like, for instance, like one instance, like Neon on Solana, or like, something where it's like, hey, they're actually like doing something new that's like more like needed in like some ecosystem that doesn't have it. But there was way less of the like, hey, I'm going to invest in like more clones because like there's a bull market and you'll be able to get out of like the 500th compound fork or whatever on AVAX. And so I think a lot of it has definitely focused on really kind of like finding people who've been around for a while, because I think Ethereum developers who actually have run products live who then move to Solana are like probably the best capable developers. And I think a lot of the new Solana devs came from not crypto and kind of tried to like apply their mindset from some other field, and so missed seeing some of the holes of like what would happen under these edge case scenarios. And I just think in a lot of cases, it's just like there's a lot of maturity you learn from building a failed project, or like something like that. And like, I think that's something I look for almost more than like, hey, right now this is hot and will work.
Like digging into Gauntlet for a sec, Tarun, like you guys have these, I think what you guys do is you like battle test these,
Yeah, so we kind of do sort of like monitoring and optimization for DeFi protocols. So we kind of do two types of things. One is risk management, which is, hey, like how, each community has a sort of notion of like how much risk they want their protocol to take, like how much leverage it takes, things like that. And they also have a notion of how much revenue they want to make. Like, do they want to be more aggressive with sort of more, illiquid assets? Do they want to like charge higher fees on these like assets? And so we help monitor and optimize that, and automatically submit governance proposals, and like make sort of analytics that people can use for that. And the other is sort of related to what you're talking about, which is incentive optimization of like, how should you actually spend this to achieve some high level metric? Like, if I'm Sushi, like how much should I actually spend on each pool to like reach, kind of optimize like the amount of volume I get per unit of liquidity. And so we really are focused on just like optimizing protocols in different ways.
You're talking about these like, Empire is proud to be supported by Paraswap. Paraswap is one of the leading DEX aggregators in crypto. Let's say you're booking a flight. You would never go directly to an airline, right? You'd never go directly to United or Delta. You'd obviously go to Google Flights or Expedia or Kayak or Booking.com. That's what Paraswap does for DeFi. Paraswap, if you're watching on YouTube right now, you can see the platform. Paraswap makes swapping easier. It makes it faster. It makes it cheaper by aggregating more than 80 different DEXs. Again, if you're watching on YouTube, Uniswap, Sushi, Balancer, Bancor into one single interface. You can use Paraswap on ETH, Polygon, as you can see here, BSC, they recently launched Avalanche a few weeks ago, pretty exciting. If you are a trader listening to this, you are losing money by not using Paraswap. And excitingly enough, if you're a company or a platform looking to access the swapping or the yield capabilities of DEXs, you can now use Paraswap's APIs to integrate into your platform to get the full power of the DEX aggregator into your platform. So head on over to paraswap.io. Again, if you're watching on YouTube, you can see how simple it is to use. Just plug in, let's say I want to swap, 0.2 ETH. For USDT, you can see how simple it is. Just plug that in right there, and it aggregates over 80 different DEXs. So head on over to Paraswap, Paraswap.io to use the platform today. All right, let's get back to the show. These developers who weren't around in 2017 and 2018 and 2019, now coming into crypto, they didn't build on ETH before. Like, they're just going straight into Solana. One thing that happens in bear markets, and I have no idea if we're in a bear market, but the prices are down like 50%. So one thing that happens when prices are down 50% is that things start to unravel. So and it happens in equities too, right? Like Bernie Madoff could have run that Ponzi scheme forever if 2007, 2008 financial crisis didn't happen. That's why in 2009 Bernie Madoff got kind of uncovered. And the same thing, I'm not saying things aren't in crypto or Ponzi's, but like things start to fall apart and unravel. And we were talking about obviously like the Frog Nation stuff and Wonderland and Time. Like that's one of the reasons like something like that starts to happen. So Tarun, I think I'd go back to you just because of like your experience with Gauntlet. What are some things that maybe folks aren't seeing in DeFi right now? Like what are like the big risks to the system right now that people aren't really looking at, but you think they should be looking at?
Yeah, I mean, I think a lot of them, the deleveraging was quite harsh in some places. I think like I would say right now is actually pretty okay, except, maybe in like the most high risk types of protocols in especially in Solana and Avalanche. And I think in Solana it's just more like, the dev team there's working really hard on getting them to have a fee market. And I think like once they have that, it'll be a lot more easy to reason about the safety in those systems than it is right now. But I think one place people are maybe underestimating their risk is in some of the on-chain options protocols. I think like we did see like a huge deleveraging there, like a little more violent than I expected. And I think a lot of these sort of on-chain derivatives protocols, there were some that did really well actually, and some that didn't. And I think like the retrospective on those is kind of interesting. Like when you compare, say, like like a Mango or a Drift to each other, right? They had very different sort of net liquidation losses and stuff like that. So I guess the main point is I think the deleveraging has shown us who the emperor with no clothes is to some extent.
I think a lot of products implicitly have an assumption that like number will always go up, and there will always be a bid, and obviously those things don't tend to be true. This one might annoy some people, but I do feel that even AMMs are somewhat subject to this. People kind of forget this, that like UniV1 and UniV2 LPs were losing a lot of money in sort of like 2019, 2020, because there wasn't enough volume to offset the IL. So, you're bleeding out slowly over time as asset price drifts, but you don't have any volume on the AMM to sort of compensate for that. So I think of it a little bit like a hula hoop, where it's like you need the momentum to get going to sort of keep the thing running. And I don't necessarily think like we're going to enter a period where we'll have such low volume on these AMMs that it will not be profitable for LPs. And I think LPs are getting more sophisticated over time. But there is certainly that risk that you enter a period where you sort of start, circling down the drain, where you don't have enough volume on the AMM to compensate the LPs, and then LPs leave, and then you also don't have volume because you don't have liquidity, and the thing just sort of accelerates.
And to be fair, I do want to say that like, these deleveraging spirals are common to everything. Like I still want to stand by my favorite phrase, which is everything's a Ponzi scheme if you squint enough. Whether it's Google AdWords and the ad exchange, whether it's the fintech investors who want to shill Stripe and Bolt, whether it's, long-ended funds, everything does have to have this like kind of like start with this rapid growth that is like unclearly connected to the thing that's inside, right? And like even for a lot of big tech companies in the beginning when they're growing, they have the same kind of problem. They have these liquidity management problems. in their platforms. So marketplaces oftentimes will have kind of these secular events that like cause this huge crash, or like all the Uber drivers suddenly turn their Uber off in some city, and like now, you know, you have to pay a ton of incentives, and the way you pay the incentives is you take like future revenue and pay it to the current drivers, and then like later compensate people like once you've accrued enough. And like there's all this sort of stuff that goes on behind the scenes. And it's just that we don't call them kind of Ponzi looking things because like some of them are sustainable. A lot of them aren't, right? Like look at Evergrande. Look at like all of these like horrible corporate bond issuances. It's the same thing as some of these underwater protocols. So I guess I just want to point out that like, you know, crypto just makes it very transparently a Ponzi, which is why everyone is a little bit, you know, always skittish and like, you know, has this kind of negative aftertones. But pretty much every investment vehicle has to have or entity has to have these problems. And I think to Tom's point, the flywheel for a lot of traditional tech companies has been like sticky user growth. And one of the things that we haven't found in DeFi, we kind of have in NFTs, but really non-DeFi, there is like sticky users, right? Users are way more mercenary than, you know, like Facebook users posting pictures, right? And so I think one interesting thing that we might also see this cycle is how teams that are not like trying to just like make a quick buck, but who like want to build a really big product, you know, really work on figuring out how to make like users sticky in a way that like is sustainable.
Tarun, it's like you're reading my mind. You laid up my next question nicely, which is what I was going to say. Is I think there's a lot of analogies to be made between like early liquidity mining incentives and then like Uber making it so all the cab rides in New York are like $4
free.
When now 7 years later it's like $35 for the. I'm like, I swear this ride used to be $4. But the difference is that like Uber's super sticky, right? So as soon as I take an Uber, I'm like, oh my God, this is freaking amazing. I'm never getting a yellow cab again. I'm taking an Uber forever. But the difference is like in liquidity mining incentives, it's like, oh, I'm going to hop into this pool. Oh, wait, now the incentives are lower. I'm jumping to the next pool, and then I'm jumping to the next pool, and I'm jumping to the next pool. And now I think what you're seeing is like VE, like the VE models are clearly what they're trying to do is make it so these token holders are maybe incentivized to hold for longer periods of time instead of just like getting incentivized, getting the tokens, and then dumping. Now you've got the VE models. But it doesn't feel like to me like VE is like the final form of this. I think there's got to be a better way to, because again, VE is still so focused around the tokenomics. I don't think you can have a sticky product just be sticky because of the tokens, if that makes sense. So what is the evolution of this? Like, where does this go? And how do you make these things sticky?
I think for DeFi, it's going to be interesting. It's not totally clear. Like, at least for Compound and Aave, it's kind of clear. Like, right in Aave's case, it's like Flash loans just completely dominated and helped stabilize a lot of DeFi. So, like, there's a ton of liquidity there because of that, right? And for Compound, it's sort of similar. It's like generally like a safe enough place for like fintech companies to feel comfortable putting their assets, right? And they have these sort of more slow moving investors using their protocol versus kind of like the mercenary HFT people, which, you know, I think to some extent that is very good to bootstrap with, but it's kind of it's a double-edged sword, right? Like it can all leave all at once. I think the interesting thing about NFTs is that, and like I'm not saying that this can't change, but it has really been OpenSea's dominance in spite of like all of the people attacking them, in spite of all of these like everyone and their mom trying to make like an NFT platform. Like, I feel like every time I meet a crypto person, I just hear a rumor that's like XYZ brand in the traditional fashion world is like making an NFT platform. Like, none of them are going to beat OpenSea. Like, there's no way, right? Like, the wealth effect of OpenSea is actually quite strong. So it's interesting that like NFTs do have this stickiness in a way that DeFi doesn't, and I don't know how that evolves. Tom is much more of the NFT giga whale, so to speak, than I am. So I don't really know.
What a claim, Tom. What a claim to fame right there.
At least you do a lot of NFT analytics. So I mean, you're like you're watching that market in a way I don't really pay attention to.
Fair enough. By the Giga Whale launch is coming out soon. It's a 10K limited PFP, so everyone go mint. I mean, I think OpenSea is just a testament to the power of network effects, especially in a mostly commoditized space. Like, you know, I think maybe you were asking earlier about building in a bear market, or different, just what sort of advice do we offer companies? And I think they have many competitors in a commoditized space, and then it's like, you know, there's not a fifth place, you know, staking derivative that's like totally fine. It's like you need to either be the largest and be everywhere, or like you basically have nothing. And so I think in those scenarios, it really behooves you to move super quickly and be number one, because in that case, success, you know, begets success, and failure begets failure. I think, you know, I guess in my mind, it is just kind of around building products that are providing services that people can't get elsewhere. I think Ribbon did actually a really good write-up when they did their first liquidity mine system. I think actually they did a really, really great job with the token in terms of structuring, you know, the airdrop correctly, in terms of experimenting with liquidity mining and learning how it works and using that to inform the product decision. So many teams I meet, you know, on the seed pitch deck, they're like, and then we're going to spend, you know, 15% of our token liquidity mining. It's like, well, how do you know that's the right amount? You know, what if it's too much? What if it's too little? Like, what if there's something else you can do with the token? And so, you know, that's not the way a normal company works. They're not like, we're going to spend $5 million this year on this particular like ad placement. It's like, what? Like, how do you know if it works? You always do experiments. I mean, for context, I used to run ads product at Instagram, and you know, it's always about getting advertisers to experiment. You know, learn that it works, and then slowly ramp up over time. And projects in DeFi just don't really do that. And so with Ribbon, they did an experiment where they did 1% of the token supply to liquidity mine their vaults, and then measure how retentive those newly gained users were. Was it just mercenary capital that, you know, took the RBN and farmed and dumped it and moved on, or are they actually sticky? And I think they found that, you know, some of the users were sticky, some of them were mercenary, but it's like doing that kind of you know, experiment and analysis is actually really key to having good growth and having good product insights. So,
not to add a tiny shill, but one of the things that I think like Gauntlet's second main product is actually this experimental design incentive optimization piece, where we design the experiments and like basically run them for DAOs, for like, you know, how much should you spend, what is the what are like the high level KPIs that you want, like, and tracking the different types of users, and then being like, hey, like, this is your spend efficiency. And so, yeah, I think to Tom's point, a lot of the stuff from Web 2 and trading will sort of bleed into services like ours that try to do that for people.
I'd love to see, I had this idea a while ago and I haven't really seen anyone do it, but you know, if you think about something like Facebook ads, right? In reality, these days, it's almost all automated, right? You say, hey, I want to achieve this outcome. Here's my like break even. And then the machine just does its thing and it determines the creative, it determines the placement, the people, the time. You're not actually selecting those things yourself. And I'll just see someone do something kind of like that almost for liquidity mining, where it's like, you know, basically auto tailoring the projected APY based on what is like the minimum required APY to like suck in sticky users, and like look at what else is out there, you know, in real time to determine the issuance rate.
Thank you for advertising our product.
I feel like we're just plugging Gauntlet right now. I agree with you. So Mike and I have this, one of our close friends is head of data analytics at like this big retailer. Tom, you were on the product side at 0x and also on the ad side at Instagram. Is it a lot harder? I would assume it's a lot harder to get deep product data on crypto protocol, like users inside of crypto protocols, than it was to get like deep product data on, let's say, Instagram users, for example.
Yes and no. I mean, I think once you're inside the company, you know, depending on the company, Facebook has incredible, you know, data infrastructure. So you can get data on anything that you want and you know, stitch it together and sort of do any sort of analysis that you want. Obviously, in crypto, you know, the majority of the data is on chain, but some of the important stuff is off chain, and so it's not going to be, you know, great. But it's gotten so much better in the past 3 or 4 years. I remember when I was at 0x, one of the first things I did when I joined was build out our very first data pipeline, because, you know, back in those days, and even still today, I think people who haven't worked in product don't really have great intuition oftentimes around data. They report like cumulative metrics, or they don't know how to like, you know, segment correctly, or they don't know like what the actual, you know, right metric is. They don't look at things like market share as opposed to just looking at like absolute volume, churn.
So in crypto, no one likes reporting churn, which I find hilarious because it's like probably one of the most important metrics.
But the thing is, I don't think it's intentional. I think a lot of them just don't know or haven't been trained on like, how to sort of operationalize data. And so I think in crypto, it's gotten a lot better. Like Dune, I think, is in large part responsible for this. Nowadays, unless you're not a real project, unless you have a Dune dashboard, and the Dune dashboard is open and auditable. It's not just take our word for it. It's on some closed source website. Everybody can go in and inspect the data and sort of make sure that it looks correct. So I think every major chain, there will be some sort of open queryable product for it.
Yeah. All right. I want to kind of get off tokenomics for a second and dig a little more into DeFi. As someone who's not as deep into DeFi as you two are, but like knows enough to look at some of the data and like looking at the TVLs and things like this, it does feel like what happened is DeFi summer took off in summer of 2020 and it like created this massive DeFi industry. And then the attention shifted to like gaming and play to earn and Axie. And then obviously NFTs had like boom and then came back down and then like another big boom. And now NFTs still having their best month ever. Like Bored Apes just hit 110 floor, 115. It's like completely bonkers. To me, it feels like tier one DeFi has to make this comeback at some point. Like it has to feel like some of these things are undervalued. I'd like your guys' take on that.
I mean, yes, I think I generally agree. I think there is a tendency in crypto to go after the shiny new thing, as we were talking about earlier. I'd rather fork and launch my own protocol on Avalanche rather than trying to improve the value of Compound by 20 or 30% or whatever. So there's a component of that in retail investing as well. People want to find the low cap gems as opposed to buying something like Compound or Uniswap that has real usage. I think there was also just a move to sort of like second order DeFi over the past year or so, where derivatives really took off, things like option vault really took off. I think those kind of things were captured more of the attention versus improvements to some of the sort of core primitives that we saw in like 2020. So I don't necessarily know if it was DeFi was dead as opposed to like there's being a shift to sort of the next stage in the market. So I think these things will come back, and like I said, the usage is still incredible. But I think just naturally retail investor tastes has shifted a little bit, and I think entrepreneurs are as well are looking for sort of the next big thing and not just trying to make incremental improvements to existing products.
Never forget the king, I guess. Maker is up like almost 25% this week or something like that. So to your point, I think there is kind of this like a little bit more flight to quality. Like Maker didn't take as anywhere near a big a hit as the rest of the market. And part of that is like showing its resilience in a time where everyone else kind of had like lots of issues.
Yeah. I feel like Maker's coming back into the fold a little bit. Maybe I'm biased because Ben Foreman from Parafy just came on. I have a question actually about just how DeFi performs in a bear market. Bull case, like I'm looking at the Uniswap chart right now, and Uniswap's down from, it was $44 in May of last year. Now it's down to trading at like 10 or 11, right? So it's down a decent chunk off its highs. Bull case for, or in a bear market, the bull case is that like Uniswap and Compound and Maker, these things actually generate cash flows, right? So they become really attractive, especially as kind of the institutional side of things moves into DeFi. These things are spitting off cash flows. You can almost make like sexy little models off of them that the traditional folks like. So that's like the bull case. The bear case is that the cash flow is denominated in their native token. So the earnings power actually goes down as the market continues going down. And also just like, they're really easy to be copied, right? Like you can fork them and put them on an L1 that like has more attention on it, or there's maybe like more rewards to be earned in like gaming or play to earn right now. So what is your opinion on how DeFi performs in a bear market?
I think things that inherently have a assumption that there's going to be a strong demand for leverage will have issues. I think, you say Maker, and I think obviously now Maker is very large. They're diversifying their collateral. They're adding real world assets. Like they're trying to be, like the global central bank and be able to, onboard any sort of asset. But implicit in there is the idea that people are willing to, take out loans against different types of assets, oftentimes for leverage, maybe most of the times for leverage. And I think, those rates will probably compress over time as people are less inclined to to do so. I think also stuff that there's some products that look more like index funds, and there's some things like Yearn, right, which is also sort of inherently based on asset prices being high and there being yield to sort of farm. Those cash flows are also probably going to go down over time as well. And so I think you can sort of look at your favorite protocol and say, well, like, does the price of this asset need to keep going up for this thing to work? And those are the things that are not going to do super well, or do interest rates need to be high? It's sort of another bellwether of potential issues in a bear market.
Yeah, I think one thing to separate is protocols that actually earn revenue in stablecoins and ETH, interest rates that are paid in Compound and interest rates in Aave. Uniswap's a little bit of a weird case because, the fees don't really go to token holders per se, and it's a lot more complicated probably for them from a logistical, legal, whatever jujitsu standpoint to actually get the cash flows to token holders. But I do think an interesting thing that's sort of the dual and of the sort of hey, how do we like automatically figure out what the incentive spend should be, is how do we make sure these protocols can actually update how they can collect revenue and redistribute revenue. And I think like that's something that will be a very big area potentially for a protocol that does that for other protocols. But I think we're a little far from that design wise. But something that sort of manages like helps protocols manage their revenue and realize these kind of like real cash flows, which are like stablecoin and ETH and payments. And then also, one of the biggest things that, I've been thinking a lot about at various points and have been trying to find someone good to incubate this is like a M&A protocol. So like you could imagine that in a bear market, like something that we already are seeing some of these, right? Like, but they're very manual, right? Like the Ferrari merger was this extremely manual process. There wasn't the way the price was determined was not like a market/competition price. It was just like people put out a price, then governance voted, then people put, and it was like very inefficient. And also then they had to just go manually do the token swap of like go to the Rari treasury and send it to there's so many moving parts that it just like looks like investment banking. But in crypto, you could actually automate a lot of that and make some type of like auction process where both sides of the two merging parties kind of can like the token holders can kind of like compete in some way to figure out what the merge price is. You can automate like the merging of governance, right? Like we've kind of come to this shelling point in a lot of ways on like the compound governance contract in Ethereum, or like I think in Solana it seems like it'll be Tribeca DAO. Which I don't understand why that's called Tribeca DAO, but whatever. Because none of the people working on it live in New York, so I was like, what? But it's kind of weird. But the upshot of this is that like I think if we have standardized governance layers that like people kind of use as a shelling point, the same way people just copy Uni v3 and copy Compound and Aave, I think we can start thinking a little bit higher of like, hey, how do we make a protocol that automates like what an investment bank would do, right? And like Ferrari showed us like, hey, you can do it. It's just like, right now no one's bothered building the tools. But I think that will be a big thing in a bear market, is like tools that do these types of stuff, like management.
Like fully on-chain crypto native investment banks that focus entirely on like A protocol M&A and B protocol financing, like that kind.
Yes, but I think won't be like investment banks make their profit from bundling all these things and forcing you to buy everything, right? I actually think in DeFi, the unbundling of the investment bank and like having a protocol that does like one function and you can glue them together with composability however you want will be the way that like this stuff gets done. Like
a protocol that does like financing for DAOs, and then like there's another protocol that does like mergers for DAOs or something like that.
Exactly.
Okay.
I'm really bullish on teams that are doing bond issuances for DAOs. Like naturally, this is not super attractive in a bull market when you have an incredible treasury and you're better off just selling tokens, but nobody wants to sell their tokens at the bottom. And so you're much better off tapping the capital markets. Maybe your treasury is much smaller than it was as well. And so there's a couple teams that are working on busy helping DAOs get access to working capital without having to sell. And I think those are also going to be doing super well in the bull market when teams need to grow and finance and maybe buy stuff up cheap.
I'm just going to say, in general, it feels like not even just DAOs, not even like DeFi native companies. In general, I think crypto companies can do a better job of getting access to non-dilutive capital. Centralized CeFi companies, DeFi companies as well. It feels like that space is like ripe to grow in crypto. One thing I want to dig into is just like DAO to DAO services a little bit more. Like, let's say Blockworks right now makes money in a couple different ways, but one is like sponsorships. And the way that like the total addressable market of like crypto sponsorship dollars is growing, right? Because companies like our clients, like they used to raise $10 million, now they raise $500 million. And like some of those dollars go to product and engineering, and some go to marketing. And like Blockworks eats some of the marketing dollars to help these companies acquire users. And like that's kind of our business model. But when I look at some of the DAOs, they've got like $8 billion in their treasury or like $4 billion in their treasury. And it feels like nobody's servicing these folks and nobody's like looking at that chunk of money and being like, holy shit, there's $5 billion in the treasury.
I just think it's like right now the products that DAOs can convince all their token holders to spend on are extremely niche and very related to management of the protocols themselves, right? But to Tom's point, if there's more DAO tooling, then like DAOs could spend on marketing and like stuff like that, right? Like right now, most of the DAOs that spend on marketing are like the Gnosis Safe plus group chat type DAOs, right? Not like the real like actual governance proposal DAOs, right? And like, Tom and I are both in Pleaser DAO, and Pleaser DAO spends on marketing. They spend on a ton of other stuff, but that's very manual, right? There's like 5 people on the multisig who determine how they get spent. And I think like the more we can bridge the gap between Constitution DAO, group chat plus multisig, and like, actual governance, on-chain governance contract, the more you can spend on things that aren't just core protocol development auditing effectively.
Yeah. It was funny. So we have this big conference coming up, permissionless. Tom speaking. Tarun, you should get involved. But like our thesis originally was like a lot of the DAOs are going to want to get involved, right? And we look at when you look at the companies on the website that are sponsoring, it's like Coinbase, 1inch, Fireblocks, Ledger, MetaMask, Nansen. Like it was really tough for us to sell into the DAOs because there's like all this. Usually like what we do is like we jump on the phone with like the chief marketing officer of Coinbase or like the CMO of Fireblocks, and like we talk through a deal and we figure out something that works, and we sign the deal. It takes like a couple of weeks or something. With these DAOs, it was like we tried to pitch like the Uniswap DAOs, like 2,000 people voting on it, and they're like, there are VIP tickets involved. Like we don't want VIP. Like no, it's for the people. I'm like, oh my god. I'm like, all right guys, back out of the Discord. So it's just it's interesting.
I think Maker, in some respects, is further ahead in governance here than a lot of other DAOs, in that they segment budgets by core group, or I forget what they actually call them, like module. So it's like, instead of groups.
They did just fire the marketing team though, that was like a big controversy.
Content team.
Yes,
yeah, it's the content.
More in concept of basically having budgets for these different functions and letting people unilaterally decide how to spend them once they're approved, instead of having the DAO manually approve every single decision or every single budget, which looks more like how a company functions, right? Like not every single budget line item goes to the board to vote. It's you hire executives, and those executives hire executives, and those executives hire ICs to decide how to spend the money, and you can move a lot faster, but with still sort of retaining this oversight and function of token holders, for example.
Like DAOs, I think people are getting DAOs like a little bit wrong. And like, honestly, who am I to say this? But like DAOs, it feels like right now they're like, oh, DAOs, like the entire community is going to vote. But like when I think about, again, I'll just take it back to Blockworks. Like if we had to have the entire company vote on every single decision we made, like I can guarantee you there'd be no Blockworks right now. And I think a lot of companies would say the same thing. So when I hear like DAOs and like I'm trying to think about like what is the real value prop of DAOs, I'm starting to think that it's not the governance of DAOs actually, but just like
one of the many reasons is like international like labor and capital laws would basically be like, this is not a company. Like, why do you have people from like 5 different countries like working on the one entity? I prefer to think of DAOs as like a way of removing nation state borders to companies, right? Because companies have a lot more in terms of like nation state borders, right? It's like the companies in a country can only hire people who are legally allowed in that country, can only make payments in a certain way, can only issue equity if you have XYZ status. And DAOs remove that, right? So, but like the fact that they're going to do the same things as companies is kind of this red herring. It's more the fact that they can kind of remove this bordering aspect of companies.
I completely agree with you, Tarun. Yeah, like in my mind, DAOs are just an evolution of like corporate structure built for a remote world, and B, a totally global, like international world. And then also C, like they like in the founder seat, like it's a pain in the ass to issue equity. It's really, really difficult and really hard. And there's like all these like 18 different types of equity, and like it's really complicated. But DAOs just kind of they make it's like corporate structure for the remote world, international world, global world, but also it makes it much simpler to issue equity, which I think is a big value add.
I think the DAOs are flat governance structure and pure democratic vote lays like kind of a straw man, the same way like every single layer of the stack needs to be decentralized and you need to like compile from source, like is also a straw man. Like it's simply sort of like a clay that people then use to build into whatever it is that they want. It has some nice properties to it, but there's nothing inherent about that, about how you actually want to run your DAO or how it should be structured.
There's sort of this, there's this natural like tendency to like these hierarchical structures, right? But the difference is in the Industrial Revolution, it started with like 100% centralized at the top power, right? Like the barons of the Industrial Revolution would just tell people what to do. It was less structured. And in decentralized land, it's like absolutely no structure, everyone votes, right? But they're both kind of converging to the same sort of like natural equilibrium of like hierarchy, structure, groups, like assignment of budgets, whatever. And I think the interesting thing we saw from the Industrial Revolution to now was that there was this whole set of B2B companies and services built like for handling your registration in other countries, for dealing with labor laws, for like payroll, for ... right? Like this whole, and all of that stuff makes it possible to even like run a company in many places. And so I think basically you're going to see the same thing, except it's going to go the other way of like, how do we add in, this like structured control versus like, how do we remove structured control, right? Like in the Industrial Revolution thing, it was more like, how do we remove it and outsource it and slowly like break things up? And here it's sort of like bottoms up, right? It's like top down and bottoms up, and they're going to meet in the middle at the same hierarchical tree structure. Maybe that's like a weird version of history, but like that would be kind of how I would.
That's good. There's a good book about this, but like I think it's just The Company. It's about like the history of joint stock corporations. Yeah. And DAOs are just speed running this. So,
but like so tying back to that book, then Tom, like I think the like C corps or something. I think it was either C corps or LLCs. One of those was created because like you needed to basically fund the building of railroads or something of that sort. But you couldn't go raise a bunch of money because the investors didn't want to be held liable. So then you had to create like the LLC because investors didn't want to be held liable, but they still wanted to invest. And like the creation of the LLC, or maybe it was the creation of the C Corp, I forget. I think it was the LLC, enabled you to then be able to raise a lot more money, which allowed you to fund things like the railroad boom. Let me extend this analogy 150 years forward. Like when you think about DAOs, what can get built because we have DAOs that can't get built now, in the same way that you couldn't build railroads because you couldn't fund the railroads without this corporate structure. But then you could once you had the corporate structure.
Yeah, I mean, I think part of when I think about DAOs, I think it is about the fact that so much of our lives and digital economy and economy has moved digitally and become sort of internet native. And in that scenario, it is truly a borderless global system. And so having a single corporate entity in a single jurisdiction probably doesn't make a lot of sense. And we're already experiencing this, right now, right? Like people are working in many different locales, maybe for a Delaware corp, but it's not really like representative of going into an office every day and like being headquartered in a single location. And I think DAOs are similar in many ways, where for a lot of these internet native platforms and businesses, it doesn't make sense to have a LLC somewhere or a C corp that owns the thing or that's governing the thing. And so it's like it's almost sort of like a square peg in a round hole, where it just doesn't naturally sort of fit the substrate of like Web3 to have some entity actually own and control the thing. But also has this sort of superpower in that it does do global capital formation. It does do pure fractionalized ownership that's liquid and could be used for many other things. And I think all those sort of things that people like about joint stock corporations, DAOs sort of do on steroids. It's sort of like the purest expression of it. You don't have to go through Carta, which is like this, it's sort of, Carta is sort of like for joint stock corporations what Plaid is for like crypto, where it's like this sort of janky hack that like we built on top of the creaky old system to emulate what we actually want, which is like a digitally native version of it. And DAOs just sort of delivers that. So that's kind of how I think about it.
And maybe to come full circle to the thing we were talking about earlier, where we're talking about like, hey, the investment banking services for DAOs. For the kind of joint stock corporation, you needed the investment bank because it was the only way to kind of like manage, you could view them as the original sort of corporate services company. And in that case, bundling things became more important because the cost of doing a transaction, like legally, was just enormous, right? But in DeFi, in a lot of ways, for DAOs, the legal costs are actually extremely not like setup costs. I mean, like the legal cost of like doing the transaction on chain is extremely low, right? In the sense that like the execution of the smart contract is relatively cheap, much cheaper than like lawyers trying to structure things or investment bankers trying to structure things. And so the interesting thing is like as we get to the more hierarchical DAO world, I expect that we're going to see like the unbundled investment bank. It's not going to be the bundle. It's going to be very much unbundled. And like that's like a kind of evolution in capitalism, that these kind of services are getting unbundled all at once.
Yeah, I think there's a history of digital services moving towards being flat, being self-serve, being automated. And that hasn't really happened, but I think DeFi is sort of that happening for financial services.
Yeah. All right. I want to wrap it up with one question about like real world applications. When I like look back at crypto and kind of what we've built, it's like just much better financial system. Oh, I mean, now it's like not fully yet, but like we will have this much better financial system, and like there's really cool stuff happening with gaming. But what we don't have is like like kind of those 2017 projects, if you remember. It was like, decentralized like Facebook and like a decentralized Instagram, and like social media on the blockchain, and like all those hypey 2017 projects that never worked out. When do you guys think if ever, do you guys think we see some of this like more real world, like a decentralized social media come out? And obviously it looks super different than like you're not just going to put Instagram on crypto rails, but when do we get something like that?
My bear case is I don't think we do. I don't think most of these products actually are solving a real problem. People care about censorship, but that's like a tail risk thing. 99.9999% of people on social media will never experience censorship. And I think for the most part, these products also just don't really put a good enough thought into how do you build a great user experience, and then more importantly, how do you sort of bootstrap this thing? How do you sort of overcome the activation energy required to start using a new social network, which is like one of the purest network effects out there. And so I think just building decentralized Twitter, we have plenty of decent examples of it, and none of them have been able to solve this. In my mind, this technology is sort of fundamentally a financial technology, and I think that's why we've seen sort of the proliferation of different types of financial services and things be successful first. And so I think if any of these things become successful, it's going to be through that lens. Like I would argue, BitClout was the most successful decentralized Twitter out there so far, even though it has not really had breakout growth, because it sort of bundled speculation and financial primitives in with it, or Axie for that matter, in the realm of decentralized gaming. So unless you're going to financialize it, I don't really see a good way for these things to actually get traction, because I think the core fundamental value prop of it's decentralized is just not attractive for the vast majority of users.
This gets back to our user retention piece, which is like somehow when you add in the direct financial incentives, we have not figured out how to do user retention, right? Like it really does attract a mercenary behavior. But the problem is like you don't want social media to be like playing online poker, right? In some ways, like if the moment people have too much adverse selection, they all leave, and these like social network NFT bootstrap things are just, they feel like this complicated Rube Goldberg machine that's like impossible for any single individual to understand.
Yeah. I guess the counter there, maybe counter to Tom, my counter there would be like, one thing that I think we will end up getting that hasn't taken off yet is social tokens. Like I would, I don't care what the format is, or I don't care what we call them, but like I would like the ability to speculate on people, because there's this thing that happens where it's like, you're with your friends or something and you're like, oh my God, I found this Instagram account early or something. Or I found this Spotify artist when they only had 7,000 like listens on Spotify, and people love that, right? They love showing off that they had that, and like that use case right there will get financialized because people love it so much.
Buy the NFT early enough and then show people the Etherscan link.
I mean, I agree. I think that's kind of my point, which is like, that's why BitClout was the most successful of this category, because it had that built into it. Now, granted, I don't think the execution was very good, and there are a lot of other issues, but I think something like that is probably going to be required for this category to take off. Guys,
this has been awesome. Tarun and Tom are both on Twitter. Tom's at Dragonfly. Again, you guys can go to Dragonfly's website. Pretty easy to find. Tarun runs Gauntlet. Again, pretty easy to find. Google like Gauntlet Network or Gauntlet Crypto, and I'm sure you can find it. So, Tom, Tarun, thanks again, guys.
Cool. Thanks, Jason.
Thanks.